The South Sea Company was founded in 1711 by an Act of Parliament, a public-private partnership built to consolidate and fund Britain's national debt. It was given a second purpose too, in 1713 under the Treaty of Utrecht. It received a monopoly on trade with Spanish South America, including the Asiento to supply enslaved Africans to Spanish colonies. That trade was real but stayed small and never earned the company significant profit. So debt finance, not shipping, became its real business. Hold that detail because the whole mania rests on it. There were almost no trading earnings underneath the stock. In January 1720, the company proposed to take over essentially the entire remaining national debt, roughly £31 million in government annuities, by converting it into company shares. The plan went to the company board on the 21st of January and was laid before Parliament by Chancellor John Aislaby on the 22nd of January 1720. That proposal is the precise spark that set the speculation in motion. The company would pay the Treasury for the privilege, and in return it would refinance the country. The Bank of England counterbid for the same right to convert the debt. To win, on the 1st of February 1720, the South Sea Company raised its cash offer to the government to £4 million plus a proportion of a further £3.5 million, a total that could exceed £7.5 million, and Parliament accepted it over the banks. To afford a promise that large, the company needed its own share price to rise. The bidding war did not just decide who won the contract, it tied the company's finances tightly to an ever-rising stock. Here is the mechanism that made it self-reinforcing. The company converted government debt into stock at the prevailing market price, not a price fixed in advance. So the higher the share price climbed, the fewer shares it had to hand creditors, and the more surplus stock the directors could sell for cash. Inflating the price was not a side effect, it was central to the strategy. Director Sir John Blunt, widely described as the scheme's chief architect, therefore had a direct financial motive to push the stock by any means available. To get the deal through Parliament, directors handed out fictitious shares to officials with no money down, redeemable at whatever the future market price turned out to be. It was effectively a bribe that paid more the higher the stock rose. Recipients included Chancellor Aislaby, Lord Sunderland at £500 for every pound the stock rose, Earl Stanhope at £600, and the King's mistress Countess Playton at £120. And by contemporary accounts, the campaign reached a large share of the House of Commons. King George I himself was a shareholder and had become the company's governor in 1718. When the establishment appeared to endorse the scheme, many ordinary investors read it as a signal of safety. The company manufactured demand through successive money subscriptions, new shares sold on installment credit. The first subscription in mid-April 1720 offered £2 million of stock at £300 a share with only 20% down. Then Blunt added the lethal twist. The company lent investors the money to buy its own shares, using those shares as collateral. The loaned money flowed straight back into buying more stock. People could now hold far more than they had cash for, and the price ran on borrowed money. Driven by leverage and frenzy, the stock went from about £128 in January to £175 in February, £330 in March, around £550 by the end of May, near £890 in early June, and a peak of roughly £1,000 in early August. That is an almost eightfold rise in about 7 months. None of it was backed by real trading revenue. Dividends, bribes, and buybacks were funded out of the proceeds of selling still more stock, which meant the climb needed an endless supply of new buyers to survive. To stop rival ventures from draining investor cash, the South Sea directors pushed through the Bubble Act, which received royal assent on the 11th of June 1720 and took effect on the 24th of June. It banned forming joint stock companies without a royal charter or act of parliament. In the short run, it helped, concentrating money into the blessed company. But in August, the company turned that same law on its rivals, taking out writs against 4 bubble companies, York Buildings, Royal Lustring, English Copper, and Welsh Copper and Lead. That was the pin. The rival shares crashed, and because many had been bought on margin and pledged as collateral, their holders scrambled for cash, selling everything they could, including their South Sea stock. At the same time, the first installments on the money subscriptions came due, forcing leveraged buyers to find money they did not have. Falling prices left the company's own loans under-collateralized, so borrowers could often only pay by selling, which drove prices lower, which forced more selling. The engine that pumped the stock up now tore it down. At the top, John Blunt and other insiders sold out before the fall. Once the public saw insiders liquidating, confidence broke. Nearly everyone was a seller and few were buying. By the Harvard Library's price series, the stock fell from about £950 in July to around £400 by September and £185 by December. Historic UK puts it as low as roughly £124 by December. Either way, most of the gains vanished in a matter of months. a fall of roughly 80 to nearly 90% from the peak depending on which month and source you measure. The damage did not stay in the stock. The company's banker, the Sword Blade Company, had helped pioneer this debt for shares model years earlier. On the 24th of September 1720, it stopped payments after panicked depositors demanded gold coin, setting off runs on several other banks and even pressure on the Bank of England itself. It happened against the backdrop of John Law's Mississippi scheme in Paris, which had already broken months earlier and was still unwinding, draining cross-border cash just as London needed it most. A speculative bubble had become a full credit crisis. Isaac Newton, then master of the mint, sold his South Sea holdings in spring 1720 for a large early profit. Then, watching the price keep climbing, he bought back in near the peak and wrote it down. The commonly cited estimate is a loss on the order of £20,000, reported as more than $3 million in today's money, though historians note the exact figure is uncertain. The Royal Society, which he had led, lost about £600. The famous line that he could calculate the heavens but not the madness of people is partly embellished. The earliest reliable version is simply that he could not calculate the madness of the people. The 1721 parliamentary inquiry exposed widespread fraud. Aislabie was imprisoned in the Tower. The directors' estates were confiscated, stripping roughly 82% of their wealth on average to compensate victims, and cashier Robert Knight fled abroad with the Green Book of bribe records. Robert Walpole rose to stabilize the wreckage, partitioning South Sea stock between the Bank of England and the East India Company, and became Britain's first de facto prime minister. The Bubble Act's restriction on free incorporation stayed on the books until 1825 and is commonly argued to have held back British company formation for a century. Strip away the wigs and the dates and the pattern is familiar. A hyped security with little real earnings underneath it, sold on borrowed money, blessed by authorities whose own interests were quietly aligned with the price going up. The New York Fed draws a direct parallel between 1720 and modern finance, pointing to asset-backed securitization, collateralized debt obligations, and the reach for yield that returned before 2008. The durable takeaways are common sense ones. Be wary of chasing a parabolic price. Be wary of buying on borrowed money. Consider diversifying instead of concentrating, and do not treat official endorsement, a celebrity, or a king as proof that an asset is sound. A rising price is not the same thing as a real business.